Hello everyone. Today we are taking a deep dive into this Financial Times story strategy's Teetering Financial Tower. We are going to break down exactly what happened here and what the real risks are that every investor should know about. But before that, you are watching Let's Decode the News, where we take the biggest business and finance stories and decode them so anyone can understand. If you are not subscribed yet, hit that button right now. So let us get into it. Since its 2020 reinvention as a Bitcoin treasury company, Strategy has morphed from an enterprise software business. And look, this is not a tech company anymore. It is not a software business in any meaningful sense. It shed that identity completely. And that matters, because the people buying this stock think they understand what they own, but the thing they bought 4 years ago simply does not exist anymore. Into a leveraged investment vehicle with a single volatile asset. Now think about what that actually means. A leveraged investment vehicle with one asset. That is the whole thing. No diversification. No product revenue worth mentioning. Just Bitcoin, debt, and the belief that the price keeps going up. For some investors, that is exciting. For others, that should be a very loud warning sign. Here is where things get really interesting. The shares climbed from around $14 in August 2020 to an intraday high of $543 in November 2024. And honestly, that kind of run is extraordinary. Going from $14 to $543 in just 4 years. People made life-changing money on this. And that success is a huge part of why the story keeps attracting new believers. Past performance becomes the pitch, only to fall to roughly $105 earlier this year. So here is the thing, 80% drop from the peak. That is not a dip, that is a near wipeout. And yet, because Bitcoin bounced and shares recovered to around $180, the narrative flipped back to comeback story almost overnight. The memory of 105 gets very short when the chart starts moving up again. But here is the line that really stopped me. The annual dividend bill is now roughly $1.5 billion. Right so, $1.5 billion a year in dividends. From a company whose software business contributes almost nothing, that number has to land somewhere. It has to come from somewhere real. And that question, where exactly, is the entire story, and rises with each new issuance. And think about that for a moment. It does not stay fixed. Every time they sell more preferred stock to raise cash, the dividend bill gets bigger. So the solution to paying the bill is the thing that makes the bill larger. That is not a cycle that gets easier over time. That is one that gets harder. Now here is the part most people skip over. New money pays old claims. Okay, so that sentence from the article is doing a lot of heavy lifting. New investors are funding the returns of earlier investors. To be clear, this is not illegal, and Strategy has not been accused of anything improper. But this structure only holds together as long as fresh capital keeps arriving. The moment sentiment turns, the moment markets tighten, the moment new buyers hesitate, the whole thing has a problem it cannot paper over. Here is the number that changed everything for me. The preferred is in fact unsecured, with no claim on or lien over the underlying assets. And look at that. Strategy markets this preferred stock as being backed by Bitcoin. Massively over-collateralized, they say. But legally, there is no direct claim on those Bitcoin holdings. No lien. No secured attachment. In a stress scenario, the preferred sits behind $8.2 billion of convertible debt and another $1.3 billion of a different preferred class. By the time anything is left for these holders, the Bitcoin would likely already be gone, sold at distressed prices that crushed its own value on the way out. And then there is this. The cumulative dividend behaves like financial knotweed. So here is why that matters. Knotweed is one of the most invasive and destructive plants you can have on a property. Once it takes root, it spreads underground, and it is almost impossible to stop. Using that as a metaphor for a dividend obligation is very intentional. Miss one payment and it does not disappear. It compounds. It quietly grows beneath the surface, steadily eating into whatever the common shareholder thought they owned. Skip a payment, and it does not disappear. It spreads. And honestly, that one line reframes everything. This is not a dividend you can defer cleanly and move on from. Skipping it makes the problem worse, not smaller. The obligation multiplies. And all of that weight sits above the common equity, which starts to look less like ownership and more like a very speculative option on Bitcoin after everyone else has already been paid. Now here is what nobody is really talking about. The company has made $3.6 billion of purchases in just the last 2 weeks. Right so, $3.6 billion in 2 weeks, not 2 months, 2 weeks. That pace of buying is not normal. That is aggressive accumulation at a scale that starts to affect the thing you are buying. To take its total holdings to 815,000 Bitcoin. So here is the thing, when one company holds that much of a single asset, it is no longer just riding the market. It may be making the market. Strategy buying pushes the price up. Strategy selling, or being forced to sell, would push it down hard. They have built a position so large that their own exit would damage the value they are trying to protect. That is a very difficult position to unwind, even if it does not feel that way right now. That is exactly where my take comes in. But real quick, before I give you my take, this video is for educational purposes only, not financial advice. Always do your own research before making any investment decisions. So, here is what I keep coming back to. Strategy has built something genuinely clever on paper. The flywheel makes sense until it does not. Issue preferred stock, buy Bitcoin, price goes up, stock goes up, issue more stock, pay the dividends, repeat. It works beautifully in a rising market. But markets do not only go up. And when this runs into a sustained Bitcoin downturn, that $1.5 billion annual dividend bill does not pause. It does not negotiate. It just sits there, growing, while the asset beneath it generates nothing. What concerns me most is not whether Bitcoin goes up or down. It is the structure itself. Common shareholders are last in line behind billions in debt and senior preferred claims. The equity is starting to look less like ownership and more like a lottery ticket, one that only pays out if Bitcoin climbs forever and capital markets never shut their doors. And the preferred buyers think they are protected, but unsecured, sitting behind all that debt, in a potential liquidation involving the world's largest corporate Bitcoin holder? That protection looks a lot thinner when you actually read the fine print. Smart structure, real risks, a tower that is still standing, but only because everything around it is still cooperating. If this breakdown helped you see the story differently, please like this video and subscribe. It genuinely helps more people find the channel, and we are building something here worth being part of. Here is my question for the comment section. Do you think strategy is genuine financial innovation, or is it an old structure dressed up in new language? Drop your honest take below.